Health Savings Account Rules and Limits. If you're planning to open a health savings account, the first thing you want to do is to check its rules and limitations. After all, it's the one account that could save you from having to worry about all of your medical bills. In today's video, we'll be discussing the updated rules and limitations of HSA. So let's get started. The goal of a health savings account, HSA, is basically to help you to save for future medical expenses if you have a high deductible health insurance plan. The federal government established health savings accounts as part of the Medicare Prescription Drug Improvement and Modernization Act. HSAs, like any other federal program, have rules that you need to follow in order to qualify, contribute to your account, and withdraw your funds. So the first question that we want to answer is, who is eligible to open a health savings account? You can open and contribute to an HSA if you meet the following criteria. First, you have to be enrolled in a qualifying high-deductible health plan that meets the year's minimum deductible and maximum out-of-pocket expenses. Second, you shouldn't be covered by another medical plan, let's say from your wife or husband. You should not be covered by other plans such as Medicare, TRICARE, or TRICARE for Life. Also, you should not be claimed as a dependent on someone else's tax return and are not eligible for Veterans Administration medical benefits. Finally, you should not have any alternative medical savings account that are disqualifying, such as a flexible spending account or a health reimbursement account. Opening a health savings account, HSA, works best when combined with a high deductible health plan, HDHP, as funds deposited in an HSA can be used to pay medical bills until the plan's deductible is met and your healthcare coverage kicks in. But what qualifies as a high deductible plan? In general, an HDHP is a healthcare plan that, as the name implies, trades relatively low premiums for relatively high deductibles. The HDHP must meet certain criteria in order to qualify for an HSA that can be opened in conjunction with it. Each year, the IRS establishes guidelines adjusting the figures for inflation. A HSA account can only be opened in 2022 if the account owner's plan meets the following qualifications. Number 1. The individual deductible would be $1,400 and the family deductible would be $2,800. Number 2. The out-of-pocket maximum, deductibles, co-payments, and co-insurance for individuals is $7,050 and $14,100 for families. Take note that the out-of-pocket maximum is also specified by the plan. Deductibles, co-payments, and co-insurance may all be included. Insurance premiums are not included. Out-of-network services are typically not included in the out-of-pocket maximum. How does it work? Moving on. Part of the rules and limitations of an HSA is understanding how it works. So let's go through the process here. Contributions to a health and savings account are tax deductible, meaning contributions to employer-sponsored plans will be deducted from pay. Other individuals, primarily the self-employed on the other hand, can claim deductions when filing their tax returns for the year. Withdrawals from an HSA are tax-free if used to cover qualified medical expenses. What cost are we talking about? These costs may include payments for dental and vision care, which are not always covered by standard medical health insurance plans. Most HSAs also provide a debit card that can be used to pay for prescription medications and other eligible expenses. If you can't wait for your bill to arrive in the mail, you can call the billing center and pay with your debit card over the phone. Any money in your account at the end of the year is kept there to pay for future qualified medical expenses. Balances at the end of the fiscal year are carried forward indefinitely. You own the account and its funds, and you retain ownership even if you change health insurance plans, jobs, or retire. The money grows tax-free while it is in the account. Now let's talk about the rules on contributions. But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Also, tell us in the comments section if you think opening an HSA is a good idea or not. Why or why not? Thanks. Now back to the video. How much can I put into an HSA? The IRS establishes limits on the total amount that you, your employer, and anyone else can contribute to your HSA each year. The maximum contribution amounts for individual coverage in 2021 are $3,600 for individuals and $7,200 for families. This year, the numbers have gone up to $3,650 for individuals and $7,300 for families. If you are 55 or older, you can add up to $1,000 more as a catch-up contribution. Let's go over a few more commonly asked questions about HSA's rules and limitations. Number 1. Can I use my health savings account to buy over-the-counter medications? Yes, many over-the-counter items are tax-free when purchased with your account. These items no longer require a prescription or a letter of medical necessity from a physician to be reimbursed pre-tax, thanks to the CARES Act, which was passed on March 27, 2020. The CARES Act went into effect on March 27, 2020, giving participants in health savings accounts, HSA, flexible spending accounts, FSA, and health reimbursement arrangements, HRA, access to over 20,000 additional eligible products, including OTC drugs and medicines such as fever reducers and cold remedies, no longer require a prescription to be reimbursed through a pre-tax account. So stock up and keep yourself healthy. Pads, tampons, liners, cup sponges, and other menstrual care products are now eligible. This is favorable news for women everywhere. Number 2. What if I use the account to pay for an ineligible expense? Okay, this one's very important. If you use the account for an ineligible expense, the funds will be taxed because the initial contribution to the account was tax-free. Furthermore, if you are under the age of 65, you will be subject to a 20% tax penalty. Number 3. Who decides whether the funds I withdraw from my HSA are for a qualified medical expense? Quick answer. You. You are responsible for this decision, so you should know what qualified medical expenses are. Best thing to do is keep your receipts as well, in case you need to defend your expenditures or decisions during an audit. Number 4. Can I use my health savings account, HSA, to pay for medical bills that I racked up before I opened the account? Big no. You will not be able to receive reimbursement for any qualified medical expenses that you incurred before your account was created. We strongly suggest that you create your account as soon as you are able to do so, whenever that may be. Number 5. I'd like to use the money in my HSA for anything else. Is that possible? Yes. At any time and for any reason, you are free to take money out of your health savings account. If the funds are used for a non-medical or medical expense that is not qualified for reimbursement, the expenditure will be subject to taxation, and those who are not disabled or over the age of 65 will be liable to a tax penalty of 20% on the amount of the expenditure. If you are at least 65 years old when you make a withdrawal from your HSA, you are free to use the money for whatever you want, regardless of the account's restrictions. You will be responsible for paying the income tax that is required, but there will not be any additional tax penalties. Number 6. How do I get started with an HSA account? If you want to open a health savings account, you will need to sign up for an HDHP. If you go through the Human Resources Department of your employer, they should be able to provide you with guidance regarding the establishment of your HSA. The majority of HDHPs that are sponsored by employers also come with an associated HSA provider for you to collaborate with.